Inflation figures from Britain will be closely watched on Tuesday as they offer more clues about where monetary policy is heading. Rising inflation has forced the Bank of England to consider hiking rates at its last meeting. Policymakers were split 5-3 in favour of maintaining the base rate at the historic low of 0.25%. In May, the CPI rose 2.9% from 2.7% in April. This is already at the level the Bank of England had expected inflation to reach by the end of this year. Anything in excess of 3% would turn up the pressure on the bank to look at a hike over the summer, although it is understood that the Monetary Policy Committee is still prepared to look through and overshoot it on its 2% target, as seen as a transitionary effect from the weaker pound. Recently, some policymakers in chorus with other central banks have been stepping up the hawkish rhetoric to prepare markets to expect a hike at some stage. Even Governor Carney has said he will favour some removal of stimulus if business investment and wages improve. Rising two-year gilt yields and overnight lending rates used by banks indicate rates will rise by March. The new hawkish pivot sent the pound above $1.30 to its strongest level in weeks. If inflation is seen to be accelerating, this ought to make an interest rate hike this year more likely, which would support the future strength in sterling. If it is slowed at all, it would take the pressure off the bank to raise rates, and this would send the pound lower again. ECB has been at the heart of hawkish tilt by central banks, spurring the euro to multi-month highs against the dollar in the process. Hints dropped by President Mario Draghi indicated he was preparing to call time on ultra-loose monetary policy, sparking a mini-taper tantrum in bonds and stocks. Markets bought the rumour that the ECB will consider some form of tapering this year. Risks are no longer tilted to the downside, they're balanced. Pressures are now mildly reflationary rather than deflationary. Growth has been revised higher, but inflation is not expected to accelerate as quickly. Improving core inflation is a source of comfort, although headline rates remain weak. A change in policy in this meeting is not expected. Instead, traders will for more subtle shifts in language, for example removing the pledge to expand or extend QE if warranted. Earnings season on Wall Street gets into full swing this week. Almost one-third of Dow components are set to report second quarterly numbers. Goldman Sachs is the biggest of the lot and should take its cue from the earlier bank earnings this week. International business machines, IBM, General Electric, Johnson & Johnson, United Health Group, American Express, Travelers and Visa are some of the major listed companies on the Dow Industrials to release earnings this week. Netflix is the main stock to report and will be closely scrutinised following the sell-off in the tech stock last month. Remember to follow us on Facebook and Twitter for the latest market updates. Thank you.